Thanks for coming, everyone. I want to welcome you to the last Britt Technology Impact Series event of the year. For the Center for Digital Strategies, we've had a really good year looking at digital transformation and digital business models. And I think it's a great way to close out today with some folks from the financial services sector talking about how technology is impacting them in their careers and their industries. So without too much further ado, I'll turn it over to Professor Clark to take it away.
Great. Thank you, Patrick. So a couple logistics. We see that John is actually not here. He's here virtually. So John, you're actually hovering above your classmates. So exactly. We can see you on the back screen. So if you want to chime in, just speak up, and if we're not hearing you, start waving, and we'll see you. But I will also be calling on you. So.
Okay, sounds good. And you can hear me okay?
Is that good? All right. Great, thank you. So one of the interesting facts about this talk is that these are all representatives of the Tuck 09 class. So if you don't have a lot of good questions, we'll just start asking for dirt on each of them. But since it's the end of the year, this raises an interesting challenge you can think about. What are you doing right now so that in 7 years you can be sitting in this seat with your classmates? So we're very fortunate to have, I think, some really interesting perspectives about the changes that are occurring technically and digitally within the financial services industry. And so much is going on. I think a good way to kind of kick off the talk is, rather than just have each person introduce themselves, but also talk about a particular innovation or change that is occurring relative to their particular area of focus. And I think will help educate us about really what's going on in this industry. So John, you weren't at the prep meeting, so this is going to be a little bit of a surprise to you. But I think you will be very well prepared to talk about this topic. So John, if you could please introduce yourself, and then the question I have for you is, what in the world is blockchain? All right, and I think you're very qualified to talk about that.
Sounds good. So as mentioned, Tuck 09, I went to go work for a consulting company called Opera Solutions in New York for a number of years, right after Tuck. Whoops. And mostly to consulting for financial services firms. There was a bit of an emphasis on being able to handle larger and larger data sets. So they like to think of themselves as kind of pioneers in big data. So got to work on some pretty interesting projects that way, and in the context of kind of more traditional types of consulting engagement. Actually, from there, went to go work for American Express on a strategy team there, focused on emerging technologies. Started looking into Bitcoin, actually, at the request of senior leadership, including the CEO and Amex's board of directors, back in September of 2013. And similarly stayed on top of that, but also other emerging technologies in financial services. And that was a really nice bridge into my current role at State Street, which I joined in July, specifically to lead the blockchain effort in a newly forming team at the time called the Emerging Technology Center. So the Emerging Technology Center was really born out of a management committee meeting where the global strategy team at the time presented to our CEO and senior leadership about emerging technologies that have the potential to be very disruptive to our business. That certainly did not fall on deaf ears, and really the result of that meeting was to form a team specifically dedicated towards identifying, evaluating, and prototyping these emerging technologies to see how we could apply them, and so we don't run the risk of disintermediation, and we stay relevant. As I mentioned, I'm specifically leading the blockchain effort. And so for those who don't know, the blockchain is the underlying technology behind Bitcoin. We are not interested in Bitcoin in particular, but it's really the underlying technology and the kind of value that can enable, kind of a very novel concept to solve very specific types of problems. That's really, in a nutshell, I mean, I don't want to bore you guys with too much of the details, but that's really what we're trying to see here is where could we bring in this type of technology into our own walls or work collaboratively across the industry to see where it could be brought in for our benefit, for our clients' benefits, and across the bank. So we were one of the founding banks of the largest industry consortium of its kind, the Distributed Ledger Group, through partnership with R3. So we're closely involved with them. I'm on the steering committee for them, as well as my boss, who runs the Emerging Technology Center. So you know, we're not just operating in a vacuum. We're actually collaborating with the industry to see where we could apply it.
Could you give us an example of how blockchain could be applied to your business?
Yeah, sure. So, you know, in essence, we see really four kind of key components of blockchain. There's a distributed ledger where everyone connected to a network can see the same information. There's consensus, so not only do you see that same information, but you're all agreeing that that's the one source of truth. There's kind of immutability, which is enabled through cryptography. And then there's this concept of smart contracts, which is really the ability to store and execute business logic on the blockchain. So if you take a case of a simple bank loan, which is actually a demo that we created. It was actually for syndicated bank loans. Not to go into the details of syndicated bank loans, but you know, if you think of a bank loan that has set terms, you can actually store those details immutably on the ledger so that whoever needs to see those terms can see it. But it'll actually also execute according to those terms through smart contracts, through calculating interest and repayment and all that.
Great, thank you very much. I'm sure we'll return back to that as we go through this morning's discussion. I turn now to Alex Burgess, who's from Liberty Mutual. Can you please tell us a little bit about yourself in the area that I'd like you to educate a little bit about is what user-based insurance is and how you're trying to incorporate that into your business.
Sure. So yeah, I've been at Liberty Mutual now for just a year, actually. I was doing strategy consulting at LEK Consulting for almost 6 years. So I'm new to financial services. I was actually focused more on retail and consumer products and airlines at LEK. So for the past year at Liberty Mutual, I've been very specifically focused on customer experience. And a big part of that has to do with better leveraging data to deliver kind of more personalized, seamless experience to our customers, omni-channel enablement, that sort of thing. I think less day-to-day about kind of user-based insurance because it's, you know, I think it's something that we don't play in a big way yet, and we're kind of watching and trying to figure out, you know, how to play there. But I can speak a little bit to some of the things that are going on and sort of, you know, our thoughts there. So user-based insurance, or, you know, pay-as-you-go insurance, you see some disruptors out there that are now thinking about, you know, instead of paying for an annual auto insurance policy, you would pay as you go, right? And so potentially based on how much you drive or something like that. And so there's actually a few pieces in here if we stick with auto for a moment, right? So there's kind of pay as you go and is a entirely different business model for us, right? And very disruptive, and there's some other players that are sort of starting to think this way, and we're still trying to figure it out. You know, I think the first step of that is something that we've done with, I don't know if people are familiar with telematics, but telematics is basically a sensor you put in your car. Eventually it'll be just on your phone, where we can monitor your driving behavior. And so what we do right now is we monitor driving for the first 90 days that you have a policy with us, and we can, it's a new way to assess risk, right? And so instead of just looking at your credit score, we have much more accurate data to be able to say, okay, this is sort of what kind of driver you are, how often you brake, how fast you accelerate, and so we're better able to price and improve profitability in the long run. So I think we're thinking about how do we utilize that technology outside of the first 90 days. We actually don't monitor you on an ongoing basis, but now all of a sudden you have this piece of technology in someone's car or in their phone, and you have insight into their driving behavior, but you can influence their driving behavior as well, right? So you can, if somebody's, you know, does a nice job with sort of braking or something like that, you could, you know, have gamification and incentivize good behavior. And so then we start to think about, okay, well, if we think about pay-as-you-go, that's sort of we have a very good model in place to start thinking about that because we actually have something in the car that can sort of start to measure that. So I think that's where we are right now. I think it's a very attractive model to a lot of consumers that want more flexibility, right? So I think flexibility is sort of a theme that we see in terms of consumer demand in a lot of different industries, and pay-as-you-go, I think, is one of those. You think about things like Zipcar, you think about Airbnb, shared economy. There's, generally speaking, that's one of our sort of shared economy is one of our big areas of focus in terms of innovation. And we see in that shared economy people looking for more flexibility. They don't want sort of just an annual policy that they have to pay. They want something that you can sort of turn on and off. And a little while later, I think we'll probably talk about some disruptors, and I can go into a little more detail that are doing some neat things around sort of user-based or pay-as-you-go insurance.
Thank you. So I have a 16-year-old son who's about to get his driver's license. Do you have a feature that just like shuts everything off?
We do.
Fantastic.
Yeah, we do. We have an app that you can
But it's
shut off.
interesting because he's the highest, that's like the highest premiums is that age group. So if you can get more specific pricing,
Right.
I'm all for it.
Yeah.
All right, Phil. All right, great. So Phil comes from Common Bond, a different perspective in financial services. Thank you for being here. And my question for you is about kind of the business that you're in, and that's the peer-to-peer lending market. And if you could help us understand what that is, that would be fantastic.
Sure. So my name is Phil DeGisi. I lead up marketing at Common Bond. Common Bond is a tech-enabled consumer lender that currently focuses on student loans. So what we believe is student loans should be more affordable, more transparent, and be able to be managed digitally on your phone, on your desktop computer, kind of whenever, wherever you like. My background when I left Tuck was I spent 6 years in different e-commerce roles. So I did 2 years at Walmart.com in San Francisco, followed by 3 years at a company called Quidsy. It's a subsidiary of Amazon now, where I launched a couple of businesses there. And then went to another startup prior to Common Bond for a year leading e-commerce there. So I've been at Common Bond about a year and a half. We're about 95-person team right now. We've funded about $500 million in loans to date. In terms of peer-to-peer lending, most popularized in the late 2000 or 2008 by Lending Club, and we can talk about that if some of you are following the news. By Lending Club, basically matching investors with people who want loans, sitting in between them and matching them. So really good, efficient model, technology enabled, and from a Lending Club perspective, you weren't holding a loan on the balance sheet. You were just kind of sitting as a service in between and collecting a fee. What you've seen since then, there's probably there's about 300 to 400 marketplace lenders to date in this country. And of those that have actually done kind of the neighborhood of what we've done, there's maybe 12 to 15. So there's been a high proliferation of people who are in this lending space. And you'll see generally two or three types. Generally, you see consumer lending and business lending. So in the consumer lending, peer-to-peer was Lending Club, Prosper, companies like Avant, which go down credit in the spectrum. And you see people lending it in different credit spectrums, different interest rates. And then on the small business side, you have companies like OnDeck, Cabbage, Funding Circle that are funding small businesses. And the models changed over time. What was once pure marketplace, where you want to invest on the platform and buy a loan, and you over here want a loan, and that was the service provided. You're now seeing people employ what we refer to more as a hybrid model, where people do have a marketplace where either a retail investor or an institutional investor can purchase a loan through the platform, but also you're seeing more companies hold the loans on the balance sheet and either hold them to term, collect the interest from those loans, or turn around and also securitize them. So a few different models there. Those models have different impacts to the business, not the least of which is how are these companies valued. So are they valued as a tech company, or are they valued as a bank or financial institution? What is the risk that each one is taking on, which then brings on a lot of questions around regulatory. So a lot of different kind of questions. We're in kind of the first or second inning of kind of all of this marketplace lending world.
Right, thank you very much. So we've kind of seen three different aspects of significant change that are occurring here. We have a new technology that kind of enables new forms of transactions through the blockchain. We see new relationships with customers and involving customers and their user experience in different ways and leveraging data to do that. And now we're seeing kind of new types of business model that are fundamentally changing the lending market itself. So now I'd like to take a little bit step back and think about this more broadly and think about kind of disruption more generally and what you kind of think are driving these, and what do you think is driving this disruption, and what are some of the new types of business, Phil, you just kind of alluded some of it, new of the business models that you're seeing emerging in the marketplace right now. Who wants to start?
Yeah, I mean, I could chime in from the State Street perspective. Right. So, you know, I think we're kind of viewing it a bit as kind of a perfect storm right now. I think, you know, the entire industry is facing a lot of margin compression, and that's forcing major financial institutions that have been around for hundreds of years, like us, to really kind of reevaluate and think more about how do we drive more towards being a software provider even. How do we get lean? So there's innovation going on across all of State Street to achieve that. First, there was the digital enterprise, and now there's Beacon, where it's just a complete overhaul of our existing infrastructure. I think you're also seeing, you know, significant regulatory pressures. So that's influencing a lot of this. And then, you know, you have kind of the interest of Silicon Valley. So, you know, I think Jamie Dimon in his Q1 letter to shareholders last year said it best. You know, Silicon Valley is coming. I think that's true. I think there are a lot of folks out there that a lot of tech providers that think that they can chip away at the business, and I think in a lot of ways they're probably right. So, you know, those are kind of all various aspects of why we're so focused on this, and frankly, why we created this team.
Yeah, one thing I think one thing that's interesting, particularly in related to the lending space, but you see it across even things like the robo-advisors, the Betterments, and the wealth fronts of the world is. Where this all started, and John alluded to, is kind of this idea of chipping away at some of the traditional financial institutions' business, is most of this was kind of unbundling products, right? So Common Bond, we start with student loans, and Lending Club starts with personal loans, and Betterment just starts with personal advising and robo-advising your retirement account. And then what you're starting to see now is just the rebundling, where we're all trying to add on different services, and this model starts to look pretty familiar. It's the model that's existed for over 100 years, and it's called banking. It's no one wants to be in just one product, right? So you see it in Kanban. We're piloting our personal loan product. You see it with companies like SoFi, who have brought on mortgages. You see it with Lending Club, who's actually now getting into small business lending. You see it with Betterment, who's saying, actually, now let's also take down business 401ks, not just personal accounts. So I think, you know, as innovative as it all sounds on one product, what you start to say is, okay, this all looks a little bit familiar to a very familiar business model. The one difference being, okay, you don't have the downside of legacy technology that you're trying to build on. So for example, when we launch our personal loan product, we're able to do it incredibly efficiently because we're starting with kind of a clean slate. Now, the things working against the disruptors are things like having a big balance sheet to lend against, right? The cost of capital of a State Street or a Goldman Sachs or anyone is far lower than what we have. So what we talk about a lot at Kanban is that there's a race happening between the traditional financial players and companies like us. And it's how fast can we bring down our cost of capital versus how quickly can the traditional financial players execute on a superior customer experience and superior user experience. And we're starting to see more and more examples that'll play out. Goldman Sachs has announced that they'll be launching their consumer lending arm either this quarter or very shortly thereafter, and I think that'll be a great case study to see how far the traditional players have come.
I think about a few different areas of disruption. I mean, one of the most obvious ones is autonomous vehicles that we're sort of keeping a very close eye on. So if you think about insurance, we don't know what that means for us, right? Like, we know that autonomous vehicles will be on the road in the next couple of years. We know that, you know, sometime in probably 2020s, if not then, definitely 2030, most of the road will be autonomous vehicles, right? And so what does that mean for insurance? Who gets insured, right? Like, are we insuring consumers anymore, or are we insuring OEMs? Or are we insuring sort of the technology companies that are sort of building the self-driving technology like Google? I don't know the answer to that. We don't know the answer to that, but it's an exciting question, and we sort of need to be on top of the trend and speaking to the right partners, right, to understand what our role needs to be, and we need to try to sort of drive change as well, right? So we can make sure that we're able to maintain, decent margins. So that's one challenge that's kind of a fun one, interesting one to deal with. And the other is kind of, I think, the pay-as-you-go one is I talked about a little bit. There's an interesting player here. I don't know if folks have heard of Trove, just received Series C funding from Oak Hill Capital. It's a new sort of insurance startup that is meant to give maximum flexibility to the consumer. So essentially, you can insure any asset at any time and switch it on and off on your sort of smartphone, which is crazy. And I have no idea how you get the data to do that, right? Like if I am going on vacation and I want to insure my artwork that's in my house, and I can do it for 3 days or I can do it for a month, like I have no idea how they're pricing risk for data that's specific. So I'm really interested to see what they do. But it's a huge disruption because in a few ways, right? So one, it competes with our core business, right? So if I think about, kind of home, auto, other insurance lines like boat insurance, motorcycle, if other companies are giving folks the ability to turn things on and off, and we don't have that, it's a problem for us. I was in a customer focus group a few weeks ago, and there was a woman who was talking about how when her kid comes home from college, for a few weeks, she'll kind of take him off the insurance platform, right? Because it's cheaper and she can save a little bit of money. And thinking about a lot of America, like there's a lot of value in if I can just have somebody off my policy for a few weeks. And it's a huge pain for her to have to like change her policy, right? And all of a sudden, her son comes home, I have to go call the insurance company and figure out how to get my documents in. It's a nightmare. And if there's a company that can sort of give you that flexibility in son's home and you swipe left, I mean, that's a pretty great model. And so I think, that's one. I think that, I think there's opportunity, but also a lot of risk. And then the other thing it does is you can all of a sudden insure more assets, right? Because if I can now be more flexible and I can insure something for just a few days, like the world of goods that I might be looking to insure might grow, right? Because I think artwork is a great example. On a vacation, you might not otherwise insure it, but if you can just do it on vacation, you might. So I think it'll grow the pie as well.
This is fascinating. So I got a whole list of questions from this conversation. You should be writing your questions down as well, because in about 15 minutes or so, we'll open it up to the group to ask questions. But there's some interesting juxtapositions here from what you said. So John, you said that Silicon Valley is coming. Yeah, Phil, you're talking about some of the new business models aren't so new, and the fact that it's kind of rehashing some core banking principles. I assume, John, that by what you mean by Silicon Valley is coming is that it's kind of taking a technology approach to this opportunity, and what you're suggesting is maybe that you actually need some foundational understanding of the business process and things like that. So how do you think that's actually gonna play out?
Yeah, I mean, it's a good question. I mean, I think a lot of these technology challenges that we have didn't necessarily have to be addressed when things were good, right? I mean, everybody was making money, it was fine, margins were rich, but now it's gotten to the point where that's increasingly under pressure, and so we've realized that we need to adapt. And again, that's kind of fundamentally why my team exists, right? But we definitely see that pressure coming in. I think in the case of something like blockchain, right? So I'm almost solely focused on blockchain. I think there's kind of a temptation there to take the success of Bitcoin, which completely lacked any intermediaries. I mean, at the end of the day, we as State Street were an intermediary. So I think there's kind of a temptation to take the success of that and to extend it to more complex financial transactions. But at the end of the day, the Bitcoin application was really just a very simple application and really just the first proven application of this type of technology. And really all it is an exchange of value, or really just an exchange of information. So when you go into a more complex type of financial transaction in a heavily regulated environment with systemic risk, I think that argument really falls apart to where you still are going to need those central parties and the folks who have the necessary IP to be involved in the transaction. But I certainly do think that certain areas are potentially at risk of disintermediation.
Bill, what do you think?
Yeah, I think there's a lot of opportunity to innovate in these systems, and I think there's some core tenets though that still exist. You're working in financial services, heavily regulated, heavy focus on compliance, and that can't go away no matter how fast you want to move and how quickly you want to disrupt something. If you think about something like underwriting, so how we judge risk at the company right now, there's a few things to consider. One is, it's a benign credit cycle. We could underrate you guys by the favorite beer you drink at Canoe Club, and we would probably still wind up with a great credit profile and just be able to lend to everyone and wouldn't have any default. So
it's Murphy's now, by the way.
Sorry, Murphy's. So that's one thing is like there's core principles in finance that still need to exist even if you're a disruptor. Really good risk and credit and underwriting are key principles. Understanding how to do things such that you're on the right side of compliance, and the CFPB in our case is kind of the government body that's overseeing things. So that said, there's still a lot of opportunity to disrupt, and the areas are, if we're making a loan to somebody and we have our underwriting principles, we should be able to automate everything. There shouldn't be credit exceptions that we're making. If we say this is who we're comfortable underwriting, it doesn't need to go to a human first who's then trying to make a judgment call on should we underwrite, should we not. If we're looking through our data and looking through our algorithms, we make that decision up front, and then what we're doing is using humans to kind of confirm that decision and make sure we did things right. So I think the principles are still the same. It's just the execution is where everything is being disrupted.
Yeah, and one other point I'd add to that is, Phil and I are in different types of markets, right? I mean, they're very much consumer focused, whereas we're institutional, right? We're one of the major custodians, so we're essentially a bank for the banks. I think, where you're really going to see advancements by companies like Phil's is really in the consumer market, particularly in the near to midterm. I think where we see it is potential disintermediation or capture of some of our revenue much farther down the line.
One thing that's interesting is, I was excited I knew John was working on blockchain, so it's fun for me to learn a little bit more about this because I'm a novice when it comes to this. But I think that's a great example where you have the traditional financial players who are interested in blockchain, and you have the disruptors who are interested in it. But no one's really the expert in this, neither disruptor nor traditional player yet. And it's something we follow. We are not leading on. I would say a lot of the lead, there are some startups in it, but a lot of leads are coming from traditional, in this case, that are leading the disruption. And I think about it, John touched about it, I think for a different type of bank loan, but you think about what we do, we refinance someone's loans. One of the most difficult parts about this is the person who services your guys' loan today is a company that does not want you to refinance your loan. Now, if there's a distributed ledger that sits up here where we all have access to it and perfect information, now you own your data and you're able to give us access to refinance that loan very quickly. So I mean, the power of some of this stuff is yet to be realized by neither traditional nor disruptor.
That's absolutely correct. I would echo that. I would also say, we're actually embracing the startup community as well. So we are partnering selectively with certain startups in this space. And actually, it's public, so I can talk about it. But Chain.com is one of the kind of better funded and better respected early startups in this space, and so we're launching efforts with them. They received 30 to 40 million from Citi, NASDAQ, all those guys. So yeah, I mean, I think a lot of these startups also realize that in order for them to gain traction, they actually do need to kind of immerse themselves into existing banking infrastructure. They can't just, they've realized, a lot of them have pivoted because they thought they could just come in and be completely disruptive, but then they started to realize that that was just an uphill battle that they weren't able to fight.
So one of the key things that part of the infrastructure that all of you have mentioned is regulation, right? Obviously this is a very heavily regulated industry. How do you think that regulation plays out in kind of the development of these new technologies? How do you think it hinders it or helps advance it? And what challenges do you face from a regulatory perspective?
I mean, I can speak to it from our standpoint. So we are, like I said, 90-person team. You go back a year and a half ago, we were a 15-person team. The first hire at the company was a lawyer. So I mean, that shows you kind of the importance of understanding this well. We brought in an expert in compliance with years of financial services experience. Those are roles you just have to get right as a startup in this space. Now in our case, we're regulated by the CFPB. And generally what the CFPB wants is a fair shake for the consumer. That's what they care about. So that aligns quite well to what we're trying to do. In our case, we are not lending at usurious rates. Each state has a maximum interest rate you can charge. So, if I was in a business that charged 30% interest rates, I might be a little bit concerned about what regulatory meant for me. I think generally, a lot of what marketplace lending, and just speaking to the area I know well, marketplace lending is built on is supposed to be built on transparency. And so from that standpoint, it aligns well with regulatory. But it does create overhead for you. If you're a small business, in our case, there are different laws for every single state in terms of different rates you can charge, different amounts you can charge, different rates you can charge by different types of products, whether it's variable or fixed rates. So I mean, that is real overhead that you have to invest the time on. You can't just charge ahead and try and figure it out later. So it impacts us, but I think it's not, it's something we're aware of, but it's not hindering ability to move fast, really.
Yeah, I think, for sure, insurance is a hugely complex regulatory environment. I think it's a very fragmented regulatory environment. It's very state dependent. You have separate departments of insurance in each state. So it definitely will slow down innovation, some of the trends I've been talking about. So I talked about Trove. I believe they're an Australian company. They're trying to expand, I think, into the UK. They have not figured out the U.S. market at all because of one of the big reasons for that is the regulatory environment. Is you've got 50 different regulatory bodies essentially that you have to sort of figure out, and so I think that also means that the regulatory environment it takes longer to advance, right? When sort of there's so many different independent bodies that are kind of moving, so that makes it more complex, and I think is slowing down some of these trends.
Yeah, regulation is just absolutely massive for us, and I think will be one of the biggest aspects to slowing down the adoption of something like blockchain. That being said, I think the conversation from a regulatory perspective and from the regulator's perspective has grown from very negative when the conversation was around Bitcoin to actually increasingly positive when we're talking about blockchain because of the transparency that it could enable for them in particular. So, it's definitely something that's going to slow us down. We also view it as an industry issue, not a State Street issue. So, I mentioned that we're involved in various industry organizations, such as the R3 Consortium. We're kind of earmarking sticky issues like that for the industry to sort out versus, us directly being in contact with regulators on this stuff. So that's just kind of how we're approaching it.
Great, thank you. I think this is a very important point, not just for this industry, but more broadly for kind of the sharing economy types of disruptions that we're seeing. That regulation often is a very important part of the ecosystem that doesn't receive a lot of attention. And yeah, you all pointed out that it slows it down, but once you get it past that certain point of acceptance, then it can rapidly speed things up. And it takes a different type of perspective, hiring lawyers as a startup to try to address these problems. I want to shift focus a little bit because we have a nice juxtaposition that we have some well-established companies who've been around for a while, State Street and Liberty Mutual, we have a startup, and so we have an interesting perspective of how they're going about in trying to meet these challenges. And what do you do as an organization to try to introduce these new types of changes for larger incumbent firms versus a startup? And we kind of saw that in some of your answers about what you're able to do and compared to what State Street and Liberty Mutual is able to do. I was joking with Alex that Liberty Mutual is in my research where I study the introduction of the computer 70 years ago. Liberty Mutual was a thriving, leading company in that effort. But so we have another case of these new leading edge technologies that people don't fully understand, and how are you going to introduce and develop that within your organization? So I'll start with you, Alex. What are some of the challenges that your company is facing in actually pulling this off within the company, and how are you responding to these challenges?
Yeah, I mean, I think it's a great question. So when I think about sort of build versus partner versus buy, that framework, and I think building, we're very slow to sort of relative to some of the disruptors that I've been talking about, and so building is very difficult for us. We're not as nimble, and so I think sort of partnering and investing is going to be absolutely critical for us when we think about some of the disruptors in this marketplace. We just launched a venture fund recently, so we just made our first investment. And we're thinking about some of the different players in these different spaces from a whole bunch of reasons, just sort of gather learnings, right? From how are they thinking about pricing? How do they? Can we just sort of from an intellectual property perspective, own some of this? And so that's a place that we're playing. We also have a dedicated innovation group that is sort of has kind of identified what they think the key kind of innovative areas are in insurance. I can tell you the three that we focused on so far: autonomous driving vehicles, connected home. So for our property insurance, you can imagine that becomes really critical on doing things like preventing break-ins, right? So we actually just announced a partnership recently with August Home, which is kind of like smart home locks and other things to help secure your home. And so we're thinking about connected home, and then finally the shared economy that I talked about before. From an innovation perspective, we are partnering with a lot of different kind of earlier stage companies to be able to understand and offer some of the things that they're thinking about. So I certainly say that kind of partner and invest are the two big ways that we're focusing.
And John, you mentioned that you're part of a technology innovation group. Is that something that's kind of separate from kind of day-to-day type business at State Street? I mean, how are you addressing it? I just say how are you guys kind of addressing it organizationally?
Yeah, so we're a corporate unit. So we're not responsible for our own P&L, which I guess has pros and cons. But it allows us the flexibility to test and to experiment with these technologies. Which everything we're looking at are all the technologies we're looking at are very nascent technologies. They're technologies that are years out from having a meaningful impact and actually being able to bring them in. So one of the things that we've really kind of set in place is kind of this acceptance of failure. So if we're not failing at least at some of what we're doing, then we're not pushing hard enough. But I'd really categorize our challenges into three different buckets. There's business, there's tech, and then there's kind of the legal and regulatory. From a business perspective, shopping it around, being thought leaders, trying to push people's thinking and to be able to have them see and be up to speed on the various technologies that are coming out. So for blockchain in particular, since July, I mean, I've gone around to hundreds and hundreds of State Street folks. We actually held an event for over 1,200 State Street people about a month ago, where we introduced the concept and what we're doing with it. From a technical perspective, again, just the nascency of the technology, we have to set up the ability to just kind of be off grid and do testing, but also working with our architecture IT group to see how they might be able to eventually bring it in if we get to that point, and we do see it as being relevant. And then the legal perspective is just, it's frankly a nightmare. I mean, it's just when you have a very conservative established bank and you're trying to work with startups and test new technologies, and I mean, it just it's been a challenge, but we're setting things into place to make sure that we can kind of expedite some of this stuff.
It's interesting that you often don't want to hear failure and banking in the same sentence. So I imagine that's a big cultural change. And Phil, I imagine for you, is it just a scale issue? You were talking about trying to get capital and lower the cost of capital. So is it just we got to grow and get big, or are there other types of challenges?
Yeah, we talk about growing responsibly and building a lasting business, and I think that can be at odds with growth. Often is at odds with growth at all costs. So what growing responsibly would mean in our industry is there was a Prosper, one of the biggest unsecured consumer lenders out there, partnered with Citi and on buying their loans, and with the understanding, okay, we're going to partner on this. And what happened was Citi bought the loans, and even though the market was quite poor, decided to just securitize it, dump it in the market, and it priced terribly, which really impacts Prosper's reputation and brand in the markets quite poorly. So when we think about it, it's growing responsibly. It's not just taking whatever capital we get on the lending capital side. This is different from venture capital, but on the lending capital side, it's finding the right partners. So a lot of what we talk about right now, a lot of what we're focused on right now is partnering with community banks. Community banks are kind of a dream. It's a perfect marriage for a company like ours. We have a low risk asset. These guys have a lot of cash and deposits that they're sitting on, and they're looking to put it at work in something that's going to generate return. So we're trying to find more of the right partnerships versus just, hey, whoever's going to write the biggest check, let's lend against that. So just thinking about how do we build a lasting business that's going to be here through the next credit cycle, through several years from now.
Yeah, it's interesting to try to think long term, and one of the things John was talking about was kind of partnerships and investments with very, very nascent technologies. I mean, I think about a couple of the partnerships that we've developed, and like for the life of me, I cannot think about and figure out how it relates to insurance. I can't talk specifically, but it's there's an app that relates to shared economy that we're helping kind of pilot and launch, and like the relevance to insurance, I just don't see it, and I don't think there is one, and it's really because we're just trying to understand shared economy and where it's evolving, because we know it's going to continue to evolve, and there's just value for us in kind of understanding how consumers think about shared economy and use it. And so even if doesn't have to do with our core business, from an innovation perspective, just educating ourselves and being part of the movement is super critical. And so I think that's actually a really interesting aspect and kind of way that we're thinking about innovation. So,
and insurance is, when I think of industries that think out of the box and take risk and high uncertainty, insurance comes right to mind.
But
they were leading adopters of the computer, so
absolutely.
So kind of my last question before I transition to you is we've talked about some of the disruptions that you're seeing, what you're kind of doing organizationally. Let's say you're an MBA student. It's kind of near the end of your first term. Second years, we're it's kind of too late for this question, right? I'm joking. You noticed all of these. I think every one of you said this was not your first career choice. So you came here through something else. But if you're an MBA student and you're really interested in these new technologies in the financial service industry and trying to get involved in this, what advice would you have for these students as they think about their remaining time here and how they can take advantage of that to help prepare them for this type of career?
I'll say a couple things. The first thing I'll say is, to a certain extent, it's okay if you don't have like a ton of exposure to some of the things that we're talking about. I had no exposure to a lot of things that I'm working with in the past year, and I'm learning a ton in the job, and I think that's actually kind of expected because there's so much evolution kind of happening right now in the technology space. So I think there is some tolerance for not necessarily having the background. That said, one suggestion I'll give is just staying current, on top of the news, seeing where the money's going in terms of who's getting funded in this space. I think is really interesting, and you can kind of see where folks are betting on in terms of where the future will go, and I think that's super valuable and also kind of a lot of fun to pay attention to.
Yeah, I would just say, I mean, this stuff, and I had no appreciation for this while I was in school here, but, and I don't know if it makes a difference to say it because I think I would have ignored it, but I mean, this stuff is all, this stuff is a marathon. This isn't a sprint. I mean, the amount of people from we're all in the same class. I mean, the amount of people who are in the job they took right after school from our class is, I can't even imagine. It's probably like 5% or something like that. So the odds will say that whatever you're doing in your first job after Tuck, you won't be doing it 5 years later. That said, there's two paths to get to the thing you want to do. So one is you're able to find a way into the industry you're interested in, and you get whatever angle you can to get into it. The other way is build up a functional expertise that is valuable to that. So, I mean, we're a startup. I think just know that kind of startups are different phases, have different values. When you're a 10-person, 15-person startup, it's the all hands on deck. Let's just get a smart person and throw it against them. Where we are right now, we generally do hire into kind of a functional expertise. So if you're going to another role, but you're in a product role there, I mean, those are roles that are going to be valuable to probably any of our companies. So yeah, I mean, if you're trying to do it right away and get into some sort of fintech role, then I would try and use an FYP for it. I would try and intern on the side for it, especially if you're a career switcher. I mean, showing heavy interest, going to meetups. I mean, that stuff. There's plenty of people I know I've kind of kept in touch with the industry who just come to every meetup that we do or every event in our office and reintroduce themselves, tell me what they're up to, and those are people you start to remember. So I think if you're super passionate about it, I mean, it's just extra mile stuff.
Yeah, and I think those are all really good points. And what I would add to that is kind of embrace kind of special projects, because you never know kind of where they're going to take you. I mean, there's pretty much a direct path from kind of some of the work that I was doing at Opera, the consulting firm, and kind of doing some kind of prototyping from a big data perspective. But then also at Amex, when I got the call to look into Bitcoin, I was kind of like, well, what is this geeky thing? I mean, this is fake money invented out of nowhere. But all those things kind of combined to get me into this role, and it's a really, really hot topic for the industry right now, and so it's been a lot of fun. So just embrace the special projects. You never know where they're going to lead.
Great, thank you. I could keep going, but I'm gonna open it up to you all. Any questions for our panel? Yeah.
So this is a question for John Burnett. And I know you mentioned earlier that you guys aren't as concerned with Bitcoin and the Bitcoin blockchain. And I know with the current debate with like public blockchains, so the Bitcoin blockchain versus more private blockchains, so the blockchains being developed within the financial industry, such as the one you guys are developing, that debate seems pretty familiar to the debate that occurred in the early stages of the internet with the World Wide Web versus a lot of institutions at that time were really focused on developing intranets because they didn't think something like the World Wide Web would work. Similar to how a lot of people don't think a public blockchain like Bitcoin's blockchain could possibly work. So I was just curious about your opinion on that, and do you guys like pay attention at all to developments of public blockchains when you're focusing on your own blockchain?
Yeah, no, it's a good question, and as you mentioned, I mean, it is a big debate right now. I mean, I think we see kind of attributes of both. I think there are a lot of different types of blockchain structures that are compelling right now, and for different types of use cases. I think, particularly as you think about, something like settlement finality, when you have kind of unknown minors doing the actual settlement of a transaction, that's just never going to be relevant for more complex types of financial transactions. You mentioned, the comparison to the early days of the internet. I believe I definitely see that point. However, we still do have internets, right? I mean, we have the State Street network that we're all connected to that nobody else has access to. I mean, I guess where I'm going with that is, we believe that there will be kind of we believe in kind of a multi-chain future, if you'll call it that, where we're going to have the interoperability between them for different types of transactions, different asset classes, different industry participants. So we've been considering all of it. As I mentioned before, it's incredibly early days, and so we're definitely casting a wide net, exploring all different avenues that we can.
I have a question for Phil. What do you think, you're talking about retail versus institutional capital, and I guess like lending clubs started out mostly retail, now it's more institutional capital invested. What do you think about that mix, like the risks associated with each one, and kind of the direction that these marketplace lenders will take with how they get their capital?
Yeah, I think conceptually, retail investing is really attractive to probably most of us. I mean, Common Bond, we actually started out as, it was peer-to-peer, true peer-to-peer, where alumni were funding students when they piloted the company at Wharton. So I think at some point, we'd actually like to bring back the notion of the retail investor to the platform. I think Lending Club would say that their volume is roughly 50-50 until the recent news right now, where they've kind of said they're gonna probably have to go onto their balance sheet a little more. So I think people really like the retail investor. That said, there's a lot of challenges with us. For us, our returns are much lower than a Lending Club loan or an Avant loan, where you're looking at 15 to 30% APR. So from that standpoint, it's unclear how much demand there would be from a true retail investor. What I think will start to be interesting is a few things. One is like 40 Act funds that allow that enable purchase of all these loans from different platforms, where investors can invest in those funds to get kind of access to a broad swath of them, kind of like a mutual fund or an index of these. Prosper in particular has talked about the notion of kind of creating their own fund, creating their own market within these marketplaces. I think if you ask most of us, we want marketplace loans to be kind of also just a new fixed income class, right? Just part of the fixed income asset class in the financial markets. And so we're not quite there yet, but I do think that's where it would go. But it's tough. It's tough to acquire, to have to pay for a customer and acquire a customer, and then also pay to acquire a retail investor is a tough model. It would be pretty challenging for us.
Alva.
This is primarily for Liberty and State. I mean, one of the things, both insurance and sort of traditional banking, the leaders of those companies, the top management of the companies, are very steeped in traditional ways of doing work in that industry. What's the challenges you have in communicating to them about what you're doing, about the new things you're coming? How do you overcome hesitancy about seriously considering these type of transformations that you see?
Yeah, it's a great question. I think our leadership has now recognized that the transformations it's pivotal and absolutely crucial that we get ahead of them. And so, you hear our president talk, and every time I hear him talk, he uses the line that in the next 3 years, we're going to see more change in the industry than the last 20, and therefore we need to sort of be ahead in innovation. And so, I think from, it's interesting, I would say that, sort of philosophically, leadership is there. I think it's more kind of, how do we actually move forward and implement and actually change sort of, how we work is the bigger challenge. So the recognition that we have to be evolving quickly with these trends is there. I think we're still figuring out kind of how do we make our organization actually operate that way is the more difficult question. I think we're doing some of the right things by having kind of independent bodies of our ventures and partners, establishing partnerships and sort of an independent innovation group start to think about that stuff. But it's hard. So I hear the leadership talking the talk for sure, but we're just kind of still figuring out how to walk that way.
Yeah, I mean, from a industry perspective, I mean, it's the exact same thing Alex mentions. I mean, you know, there is that buy-in from the top. I mean, that's why this team was formed. I think, you know, we've gone around to the various business units where we might be able to apply some of the stuff, and I mean, the enthusiasm is entirely there. People know that we need to innovate or else we're going to die. And so the enthusiasm is there, but how you practically go about implementing is a different story. So that's one of the things that we're trying to figure out now.
The recent lending club event, as you mentioned, has raised a lot of questions about the business model of peer-to-peer lending, especially the stability of the capital source. Are you ready for such a volatility from common bond perspective?
What was the
fluctuation of the capital source, right?
Yeah.
When investors lose confidence in the economy or in the company, they just disappear, right?
Yep. So just so everyone's aware, if you haven't kept up with the news, Lending Club's CEO resigned under some accusations of a few improprieties. One of which was the dating of loans that were going into securitization, the dates of when the loans were originated were changed, and also there was a failure to disclose ownership in a fund that was being recommended Lending Club invest in. So that has caused a lot of headlines pretty much every day in our industry. Our general take is kind of business fundamentals are business fundamentals, and so, you know, while Lending Club they are the biggest, they were the first to go, they were ahead of OnDeck, first to go public. And Renaud, the CEO, was truly the godfather of peer-to-peer. I mean, they really were the ones that started it. So it's a blow to the industry, but we don't really think it reflects on anything functional for really most companies. And in fact, one of our investors is actually the executive chairman there, Hans Morris, former president of Visa there. So from everything we've seen, I feel like it's bad. It's not great. It's against transparency, which is one of the core tenets we want this industry to stand for. But I don't think it's going to have lasting effects in terms of talking to our current investors on the lending capital side. No one's really blinked. But you know, it's a lot of bad headlines in the short term, and goes back to what I said of we do need to find very sticky capital, and why, you know, we talked at places like community banks, where the capital should be expected to be there through a credit cycle. That's definitely going to be key for ourselves and anyone in the industry.
And one more. Yeah.
So this question is for John. So with an emerging technology like blockchain, do you see the future being focused more on building out platforms or focusing on new products?
Sorry, the question was, are we more focused on building out platform or products?
With blockchain, with an emerging tech like that, what do you see as being the competitive advantage between platforms?
It's really hard.
So do you think the competitive advantage with blockchain will be to build out platforms or to build out specific products?
Well, I mean, look, we're more looking at, I would say we're more looking at it as an underlying platform that we could then build products off of. I think, you know, we're not specifically focused on building that platform. That's why we're staying on top of the industry and the actual tech providers that are. So, you know, we're seeing how we can leverage those types of technologies without actually, you know, doing the actual build of the underlying fabric.
Great, thank you.
And I think that's about all the time we have. We just want to thank all of our guests for sharing a lot of great information and spending some time with us today. So thank you very much. And we do have some gifts for you from the center. So thanks again for joining us. Thank you for coming.
Thanks, all.
John, we'll send you your gift.
These guys promised that they would take it with it.
Thank you, John.
We know we can't trust them. Thank you very much, John.